Most people think earning an extra dollar in the higher tax bracket means they'll owe more money overall. It's one of the most expensive misconceptions you can hold. Here's what's really happening when you see 22% bracket and why that number is lying to you. The actual rule is invisible but simple, and once you see it, you'll never make the same tax planning mistake again. In the next few minutes, I'll show you exactly how your taxes work, what you're actually paying, and the hidden advantage sitting in your bracket that most earners completely miss. If this makes sense, let me know in the comments which part surprised you most. Let me start with the broken belief that's probably costing you thousands. When you hear you're in the 22% tax bracket, your brain fills in a dangerous blank. You imagine paying 22% on every dollar you earn all year long. So when you think about earning more, a side project, a promotion, maybe maxing out your 401k, your instinct is fear. Your instinct says more money equals a bigger tax hit. More money equals less take home at the end. But here's the part nobody explains clearly. That's not how it works at all. The system is progressive, not flat. And that word matters more than you realize. Think of your income like filling a bucket with different colored sections. Each section has its own tax rate painted on it. You don't fill the whole bucket with the top color. You fill from the bottom up. For a married couple in 2026, the bottom section is 10% on the first $24,800. The next section is 12% on the money from $24,801 to $100,800. The third section, the one everyone gets anxious about, is 22% on income from $100,801 to $211,400. Everything above that follows a similar pattern. The critical insight is this: you never pay the same rate on your entire income. You pay different rates on different slices of income. Here's where this becomes real money. Imagine you and your spouse combine to earn $150,000 a year. After claiming the standard deduction, the math looks like this. First $24,800 times 10% equals $2,480. Next $76 times 12% equals $9.12. Next, $49.20 times 22% equals $10,824. Your total tax bill is $22,424. But here's the number that matters. Divide 22,424 by 150,000, and you get 14.96%. That's your effective rate, the average rate you're actually paying. You're in the 22% bracket, but you're only paying 15% overall. This gap between the two numbers is where money lives. Now watch what happens when you consider a deduction or a new job offer. If you get a $5,000 bonus, that money lands in the 22% bracket. 5,000 times 22% equals $1,100 in taxes. You keep $3,900. That bonus never made you worse off. It's impossible for earning more to leave you with less money after tax. The worst-case scenario with the highest bracket is you pay 37% and keep 63 cents on the dollar. You're still ahead, but the real game is understanding how deductions work in this system. This is where people who pay attention pull ahead quietly. A deduction removes income from the top of your bracket first. If you contribute $5,000 to a 401k or make a charitable donation, that $5,000 comes off the portion of your income that would have been taxed at your marginal rate, the rate on your next dollar earned. Most people know deductions are good. What they miss is that deductions are worth more the higher your marginal bracket. If you're married earning $150,000, a $1,000 deduction saves you $220 in taxes. If you're married earning $350,000, that same $1,000 deduction saves you $240. The higher you go, the more valuable each deduction becomes. This is why wealthy people obsess over deductions in tax planning. It's not magic, it's leverage. This is where most people miss the money. In 2026, the IRS adjusted all these brackets upward due to inflation. For a married couple filing jointly, the 12% bracket now extends to $100,800 instead of the prior year's limit. The 22% bracket now runs to $211,400. For single filers, the 12% bracket goes to $48,475, and the 22% bracket extends to $103,350. Head of household filers have slightly different ranges at $67,450 for the 12% bracket and $105,700 for the 22% bracket. Married filing separately has the smallest brackets. These adjustments exist to prevent bracket creep, a slow tax increase that happens when inflation pushes you into higher brackets without any real gain in purchasing power. The IRS recalculates every year, so you don't pay extra tax just because money became less valuable. For 2026, there's something else that changed dramatically, and most people haven't heard about it. Congress increased the standard deduction legislatively, not just by inflation. For married couples filing jointly, it's now $32,200, up $2,200 from the prior year. For single filers, it's $16,100, up $1,100. Head of household is $24,150, up $1,650. The importance of this number is easy to underestimate until you do the math. If you're married and earn $100,000, your actual taxable income after the standard deduction is $67,800. That $32,200 shield means most married couples won't hit the 22% bracket until gross income exceeds $132,200. The standard deduction is your tax-free zone, and it's bigger than most people realize. This changes everything about how you should think about itemized deductions. Many people still itemize when they shouldn't because they haven't recalculated against the new standard deduction. Here's one more layer that most earners miss completely. If you have investment income, capital gains follow a completely different bracket system. Long-term capital gains don't use the regular progressive brackets at all. They have their own special rates: 0%, 15%, and 20%. For married couples, the 0% capital gains rate applies to gains up to $98,900 if you're in the 22% bracket. This means if you have $130,000 in regular income and $20,000 in long-term capital gains, something remarkable happens. Irregular income is taxed using the standard bracket's $32,200 standard deduction covers $32,200. $97,800 of income taxed at 10 to 22%. The capital gains are taxed at 0% because you haven't exceeded the capital gains threshold. You're essentially earning $20,000 completely tax-free if you structure it correctly. This is legal tax planning, not a loophole. It's available to everyone, but almost nobody uses it because the rules aren't explained clearly. Pattern interrupt. Here's the part that feels small until you do the math. Let me walk through a real mistake scenario that costs people money constantly. You get offered a promotion with a $10,000 annual bonus. Your first instinct is to calculate the tax. I'm in the 24% bracket now, so I only take home $7,600. Your instinct says turn it down. Your instinct is wrong. You absolutely take the promotion. An extra $7,600 is an extra $7,600. And the math doesn't change based on your anxiety. But here's the mistake that actually costs money. You turn down the deduction because you think it won't help much. You think, I'm making decent money, deductions probably won't matter? This is backwards thinking. Higher earners benefit more from deductions, not less. Here's a second common error. You think tax planning only matters if you're wealthy. In reality, tax planning matters most in the middle brackets where the decisions are actually close calls. When you're making $60,000 and considering a $6,000 retirement contribution, the decision is clear. Do it. It saves you about $1,320 in federal tax, assuming you're in the 22% bracket. But if you're making $180,000 and considering the same contribution, the decision might depend on other factors: state taxes, alternative minimum tax, capital gains timing. The rules don't get simpler as you earn more, they get more detailed. Here's where it gets real. A common trap is confusing your effective rate with your marginal rate when making decisions. Your effective rate is your total tax divided by total income, the average across everything. Your marginal rate is the tax on your next dollar, the rate that matters for new decisions. If you're considering whether to take a consulting side project, you don't use your effective rate, you use your marginal rate. If you're married earning $150,000, your effective rate is about 15%, but your marginal rate is 22%. That consulting income gets taxed at 22%, not 15%. The consulting income stacks on top of your regular income in the 22% section of the bucket. So when you calculate whether it's worth the effort, you're saving or spending based on 22% taxes, not 15%. This is subtle but massive. A $10,000 consulting project is worth $7,800 after 22% federal tax, not $8,500 after 15% effective rate tax. The difference is $700 of actual money. Most people use the wrong rate and overestimate what they'll take home. Pattern interrupt. This is the part that changes how you negotiate. When you're negotiating salary, you need to know your marginal rate, not your effective rate. When you're deciding whether to max out a retirement account, You need your marginal rate. When you're evaluating a business deduction, you calculate its value using your marginal rate. This is the secret to quiet wealth building. High earners aren't better at math than you. They're better at using the right numbers for decisions. Let me give you the actual 2026 bracket structure for all filing statuses, so you can look yourself up and know your marginal rate. For single filers, the 10% bracket goes to $11,925. The 12% bracket goes to $48,475. The 22% bracket goes to $103,350. $350. The 24% bracket extends to $197,300. From there, it's 32% to $250,525. Then 35% to $626,350. Then 37% on everything above that. For head of household, the 10% bracket goes to $17,700. The 12% bracket goes to $67,450. The 22% bracket extends to $105,700. The 24% bracket reaches $197,300. From there, same structure, 32%, 35%, 37%. For married filing separately, the brackets are roughly half of the married filing jointly amounts. The 10% bracket is $0 to $12,400. The 12% bracket is $12,401 to $50,400. The 22% bracket is $50,401 to $105,700. The 24% bracket goes to $201,775. Then 32% to $256,225. 35% to $384,350. And 37% above that. Now here's something most people don't think about. The brackets adjust every year, and you can predict roughly how much more you can earn before hitting the next bracket. In 2026 compared to 2025, married couples can earn roughly $2,220 more before hitting the 22% bracket. Single filers can earn roughly $1,100 more. This is the bracket creep protection working invisibly in your favor. Without these annual adjustments, inflation would slowly push everyone into higher brackets without any real increase in actual purchasing power. It's a quiet defense against invisible taxation. Now here's where it gets interesting. Psychologically, most people get anxious about the wrong thing. They worry that earning more money will hurt them. They worry that accepting the bonus or the raise will push them too far into the higher bracket, and they'll be worse off. This anxiety is expensive. It's expensive because it's not based on how the system actually works. You can earn your way into a worse financial position. More money, even after tax, is more money. But here's what actually happens: lifestyle inflation. You earn more, you spend more, and you end up with the same financial stress even though you're making more. The tax system isn't the problem in that scenario. The spending psychology is the problem. This is why understanding the brackets matters more than you think. When you see clearly how much you'll actually take home after tax, you can make better spending decisions. You can see that the promotion isn't going to destroy you with taxes. You can see that the deduction is actually worth real money. You can see that the capital gains strategy actually works. Clarity dissolves the anxiety. Pattern interrupt. Here's the mistake that costs thousands of dollars cumulatively. You turn down deductions because you don't understand their value. You think deductions are only for wealthy people or business owners. You think deductions don't matter if you're not in a high bracket. This is incorrect on all counts. A deduction is worth more the higher your bracket, but deductions have value in every bracket. Even in the 10% bracket, a $1,000 deduction saves you $100. In the 22% bracket, it saves you $220. In the 37% bracket, it saves you $370. So the higher your income, the more valuable each deduction becomes. But here's what people miss: deductions need documentation and intentionality. You can randomly claim deductions. You have to track them, understand them, and be able to justify them. This is why successful people hire accountants and pay attention to their bracket. They're not avoiding taxes illegally. They're understanding their marginal rate and documenting the deductions they legitimately qualify for. For business owners, this is straightforward office expenses: equipment, mileage, home office deduction, business meals. For employees, it's more limited. You can deduct state and local taxes up to certain limits, mortgage interest if you itemize, charitable donations if you itemize, but the point is the same. Understanding your marginal rate tells you whether these deductions are worth pursuing. Let me show you what this looks like in practice. Imagine you're a married couple, earning $180,000 combined income. After the standard deduction of $32,200, your taxable income is $147,800. That places you solidly in the 22% bracket. Now you're considering whether to max out a SEP IRA with a $25,000 contribution if you have self-employment income. Using your effective rate of roughly 17%, you'd calculate the savings at $4,250. But the real calculation uses your marginal rate of 22%. $25,000 times 22% equals $5,500 in tax saving. The difference is $1,250 of real money. You're overestimating the cost and underestimating the benefit when you use the wrong rate. This is why financial clarity pays. It's not about doing anything illegal or complex. It's about using the right numbers for decisions. Most people make decisions with wrong numbers their whole life and wonder why progress feels slow. You can change that with basic understanding of how brackets work. Let me address the capital gains piece one more time because this is where real wealth building happens for most people. When you have investment income, the tax treatment is fundamentally different. Long-term capital gains, gains on investments held more than 1 year, are taxed at preferential rates. For married couples in the 22% bracket, you can have up to $98,900 in capital gains taxed at 0%. Above that, gains are taxed at 15%. Only the very highest earners get hit with the 20% rate. This creates an extraordinary opportunity that most people miss because the rules are scattered across different sections of tax code. If you're a married couple with W-2 income that puts you just under the capital gains threshold, you can strategically harvest gains at 0%. This is legal, it's intended, and it's completely free money if you structure your investment sales correctly. You're earning investment gains that produce zero federal tax. Pattern interrupt. This is the part that feels too good to be true, but isn't. You're literally earning money that escapes federal taxation completely. It's not a loophole. It's a feature of the tax code designed to encourage long-term investing. The IRS actually wants you to do this, but you have to understand the threshold amounts. You have to know your income level, and you have to time your investment sales correctly. Most people don't, because this information isn't explained clearly in normal financial education. You learn about marginal rates in economics class, but never connect it to real decisions. You learn that capital gains are taxed differently, but never calculate the actual thresholds for your filing status. This is where the gap between financial knowledge and financial results opens up. Closing that gap means understanding the system enough to make decisions that align with how it actually works. Now let me address 5 common scenarios where getting this wrong costs real money. Scenario 1. You're an employee considering side income from freelancing or consulting. You think I'm in the 22% bracket, so I'll take home 78% of what I earn. That's accurate if we're talking about federal tax only. But you also owe self-employment tax on that side income, roughly 153%. In addition, the real take-home is closer to 63%, not 78%. Most people are shocked by this number, which is why many people who start side projects abandon them. Not because they don't work, but because the tax hit is bigger than they calculated. Scenario 2. You're considering a job change that comes with a signing bonus. You think the $20,000 bonus is taxed at 24%. So I only get $15,200. That's directionally accurate, but the actual calculation depends on whether the bonus pushes you into a higher bracket or stays within your current bracket. If you're at $180,000 and get a $20,000 bonus, all of it is taxed at 24% because it lands above $211,400 for married couples. 20,000 tax 24% equals $4,800 in tax, leaving you $15,200. But if you're at $195,000 and get $20,000, part of it is at 24% and part is at 32%. The calculation is more complex, and you need to know your exact income to get it right. Scenario 3. You're deciding whether to max out a retirement account. You think I'm in the 22% bracket, so I'll save $1,100 on a $5,000 contribution. That's correct mathematically, but it doesn't account for whether that deduction actually pushes you into a lower bracket. If you're right at the edge of the 22% bracket, the deduction might bring some of your income into the 12% bracket. The savings would actually be higher because part of the deduction is worth 22% and part is worth 12%. This is where tax software matters. It calculates these edge cases accurately, but you should understand the logic. Scenario 4. You're a small business owner deciding whether to buy equipment this year or next year. You think if I buy it this year, I can deduct it and save taxes. That's true, but you should factor in your estimated income for the year. If you're going to be in a higher bracket next year, the deduction is worth more if you claim it next year. This is called timing strategy, and it requires knowing your projected brackets. Scenario 5. You have investment income and you're wondering whether to sell an investment. You think all owe capital gains tax. Yes, but at what rate? If you're in the 15% capital gains bracket, selling might make sense. If you're in the 20% capital gains bracket, you might want to wait until next year if you expect lower income. This requires calculating your capital gains brackets, which most people don't know how to do. Understanding the brackets enables you to make these decisions intentionally, instead of reactively. Let me give you a clean action plan for actually using this information. Step 1. Identify your filing status and your current or projected income. Look at the bracket table and find which bracket your income falls into. Note that number, that's your marginal rate. Step 2. Calculate your effective rate by taking your current tax bill and dividing it by your income. This shows you the difference between what you pay on average and what you pay on the next dollar. Step 3. For every financial decision, a deduction, a side project, a job change, an investment sale, use your marginal rate to calculate the tax impact, not your effective rate. Step 4. If you have investment income, look up the capital gains thresholds for your filing status. Calculate whether you're near the 0% threshold. If you are, consider strategically timing investment sales to harvest gains at 0%. Step 5. Review the standard deduction compared to your potential itemized deductions. Take the larger number. Don't itemize just because you have deductions. Itemize because it's bigger than the standard deduction. Pattern interrupt. This is the part where most people stop paying attention. They get the information, but they don't act on it. They understand that deductions are worth their marginal rate, but they don't track qualifying expenses. They understand that capital gains are taxed differently, but they don't calculate the threshold. They understand that marginal rate matters for decisions, but they keep using effective rate in their head. Understanding is only half the work. The other half is action, specifically documenting, calculating, and timing. This is why people who seem naturally good with money usually just have one habit. They pay attention to numbers. They calculate the after-tax value of decisions before they make them. They keep records instead of hoping they remember at tax time. They notice when a deduction is available instead of assuming it doesn't apply to them. They're not smarter than you. They're just more intentional. Here's what you should do next. Look up your filing status and find your marginal bracket in the 2026 tables I described. Write that number down. Now take your biggest potential deduction, whether it's retirement contributions, business expenses, or charitable giving. Calculate its value using your marginal rate. That number is real money you're potentially saving. Now the key question, are you documenting this deduction well enough to actually claim it if audited? If no, you've just identified where your attention should go next. You don't need to make big changes. You need to make intentional changes based on numbers instead of guesses. 3 things to lock into memory from this explanation. First, your marginal rate is what matters for new decisions, not your effective rate. Second, you only pay the bracket rate on the income in that bracket, not your whole income. Third, the tax code gives you benefits like 0% capital gains rates, but you have to understand the system well enough to use them. The system is designed to work this way. You're supposed to optimize it if you understand it. The people who build wealth quietly aren't violating rules. They're following them intentionally, instead of by accident. If you want to understand more about how taxes compound over time and why some people seem to get ahead while others don't, that's the next piece of this puzzle. Subscribe if this clarified how brackets actually work for you.